Welcome to Mastering Margin Trading, your go-to resource for understanding the intricacies of margin and finance. Today, we'll walk you through what margin is, how it works, and the risks and rewards involved. By the end, you'll have a strong grasp of this powerful yet complex tool. Let's start with the basics. In finance, margin refers to borrowing funds from a broker to trade financial assets. The borrowed funds are then used to purchase additional financial instruments, enabling you to control a larger position than your account balance would normally allow. When you open a margin account, you're required to deposit a minimum amount, known as the minimum margin requirement. This acts as collateral for the loan. The broker lends you the rest of the money needed for your trade. However, you're expected to maintain a minimum balance in your margin account, known as the maintenance margin, to prevent a margin call from the broker. Let's break this down with an example. Suppose you have $5,000 and want to buy $10,000 worth of stock. With a margin account, you can borrow the other $5,000 from your broker. The broker charges interest on the borrowed amount, and your stocks are used as collateral. Now, what if the stock price drops? If your account equity falls below the maintenance margin due to a decrease in the stock value, the broker can issue a margin call, demanding you to either deposit more cash or sell some securities to bring your account back to the required level. To help you understand these concepts better, let's visualize them with a graph. We'll plot the value of your margin account against the stock prices. As you can see in the graph, if the stock price falls, the value of your account also decreases. The maintenance margin is often set at a percentage of the invested amount, typically 25 to 30%. If your account value falls below this threshold, you'll receive a margin call. With this knowledge, you may wonder about the pros and cons of margin trading. One significant advantage is increased purchasing power. With margin, you can leverage your investments, potentially amplifying your returns. However, it's crucial to understand the risks. One of the most significant disadvantages is the potential for amplified losses. If the market moves against your favor, you could end up owing more than your initial investment. To illustrate this, let's consider another example. If you buy $10,000 worth of stock with $5,000 of your own money and $5,000 borrowed, and the stock value increases by 10%, your gain is $1,000. But if the stock loses 10%, your loss is also $1,000, not including interest on the borrowed amount. Now, let's tackle some frequently asked questions about margin trading. One common question is, can I avoid margin calls? While there's no sure way to completely avoid margin calls, monitoring your account and maintaining sufficient equity can help mitigate the risk. Another question we often get is, how much interest will I be charged for borrowed funds? Interest rates vary by broker, so it's essential to understand the terms and fees associated with your margin account. We also receive queries about the types of securities that can be traded on margin. Most stocks, ETFs, and mutual funds are eligible for margin trading, but there are restrictions. Always check with your broker for a list of marginable securities. Finally, let's address the question, is margin trading suitable for beginners? While margin can amplify returns, it also increases risk. Beginners are generally advised to approach with caution or seek professional advice. In summary, margin trading offers the potential for higher returns, but comes with increased risk. Understanding the mechanics, requirements, and potential pitfalls is essential before diving in. Thank you for watching Mastering Margin Trading. We hope you found this information valuable. If you have any questions or topic suggestions for future videos, please leave a comment below. Don't forget to like, share, and subscribe for more financial insights.